Welcome back to the MOOC course on corporate social responsibility. My name is Aradhana Malik and I'm helping you with this course. And in the previous lecture, we talked about a few theories of corporate governance. Now, in this class, we started the module on corporate governance. So, the first lecture in this module was what is corporate governance, then we discussed some theories. In this class, we are going to continue that discussion and talk about why corporate governance is important. So, let's see what we have for you here. Okay, why corporate governance? Now, in the previous class, we were talking about the agency problem, which means that the people who own the company, the shareholders, are different from the from the managers, from the management. The people who run the company are not the same people as the ones who own the company, and that problem then continues. And so the big problem here is the possible opportunistic behavior of the management. So we are not talking about unethical behavior, we are just talking about maximization of personal interest, which means that both the shareholders and the management try to maximize their own output from the organization in terms of profits, assets, connections, etc. Now, when the control goes to the management, the board constitutes the management and the management then starts running the company, then both have a tendency to maximize their interest or maximize what they get out of the organization, which may lead to or has the potential to lead to exploitation of the company's resources, which is likely to lead to compromising the interests of the stakeholders. So both are trying to maximize their profits, and in the end, people who may not have a financial stake in the organization may be affected negatively. Now, that is where the need for corporate governance and having transparent and accountable systems in place starts coming up. Okay, why corporate governance? To deal with the detrimental effect of deregulated labor markets on workers' conditions, employment hours and protection, wage levels and training. So some system needs to be put in place to get the nuts and bolts of the management in place. Realignment of incentives, commonly through some type of penalty for premature termination, creation of a specialized governance structure to resolve disputes, the introduction of trading regularities that support and signal intentions of continuity. So some management structure has to be put in place, some form and shape of how things are to be done has to be put in place in order to ensure that one complies with the laws, one takes care of the workers, one takes care of contracts that may terminate prematurely, some penalty has to be instituted, disputes, some mechanism has to be put in place to deal with the disputes that occur as a result of conflict of interests, etc. Then, to ensure that we do not create asymmetry of benefits between different sections of shareholders, generally the owner managers of a company and the rest of the shareholders. So, to ensure that the benefits are distributed equitably among people who have a stake in the organization or who are financially connected to the organization. Minimizing agency cost or the cost of managers who manage the corporation on behalf of the shareholders, because the shareholders also need a profit. You can't put all the profits back into the organization to run the company. So everybody tries to maximize their profit. So to ensure that the management is effective and to minimize the cost of managing the organization. Okay. Also to improve performance in terms of operating performance, which refers to the profitability or return on assets or return on equity, market value, market capitalization relative to book value, stock returns, relative change in stock prices over time, that includes return on investment, often controlling for risk and other factors affecting returns. So to improve the performance of the organization, then how does the operating performance improve? With better oversight. Again, this is directly from this paper and I'll read out. With better oversight, managers are more likely to invest in value maximizing projects and be more efficient in their operations. They do their work better. Fewer resources will be wasted on non-productive activities, perquisites consumption by the management, empire building, shirking of work, etc. Better governance reduces the incidence of tunneling, asset stripping, related party transactions and other ways of diverting firm assets or cash flows from equity holders. So, this is the way operating performance can be improved. Then, if investors are better protected and bear less risk of losing their assets, they should be willing to accept a lower return on their investment. That means that they are not really, so they don't want to take on the risk of losing their assets, which means they don't want to invest in risky transactions, in risky activities. So, when they don't do that, it's low risk, low benefit, high risk, high benefit. So, they should be willing to accept a lower return on their investment. This will translate into a lower cost of capital for firms and hence a higher income. The availability of external finance may also be improved, allowing firms to undertake an increased number of profitable growth opportunities. So, these are some of the ways in which the operating performance of the organization can be improved through corporate governance. Now, the bottom line is that when we take care of all of these things, the trust of the shareholders, the trust of the stakeholders, the confidence they have in the running of the organization are bound to increase. When everything is transparent, accountable, when things are being taken care of properly, they are being managed effectively and a structure is in place, a structure that can be viewed, that is open to scrutiny, then their confidence in the organization grows. And we will see how different countries or how different systems of governance exist in another lecture. Various types of governance exist, and some people have, or in some places you have a very strict form of governance, in other places there are networks, but that is we'll save that for another discussion. So, all of what we have said or we have talked about is likely to increase the trust that the stakeholders, the shareholders have in the organization. Shareholders for legal purposes, stakeholders for future investment, for PR, for overall trust and confidence in the organization is increased. Okay. What does good governance do? It creates sustainable value, value that sustains over a period of time. It puts in place some ways of achieving the firm's goals. It helps increase the satisfaction of stakeholders. It helps efficient and effective management. It helps with increasing credibility. People start trusting the organization more. It ensures efficient risk management. You have a structure in place, you take risks, but then the effects of that risk are again, you're able to deal with them because you have a structure in place to deal with these the actions, that the activities that you undertake. Providing an early warning system against all risk, ensuring a responsive and accountable corporation, describing the role of a firm's units, developing control and internal auditing. Things are open to scrutiny, transparency is there. You can go back and check what you did and what it resulted in and whether things can be changed in future. Keeping a balance between economic and social benefit, ensuring efficient use of resources, controlling performance, distributing responsibility fairly. You're trying to ensure that people's interests are being looked after. So, the responsibility is shared equitably. So, producing all necessary information for stakeholders so that they know what they are getting themselves into, what their connection with the organization holds, keeping the board independent from management, facilitating sustainable performance. Now, all this happens because of good governance. Benefits of good governance: it increases the firm's market value, it increases the firm's rating, it increases the competitive power. It is likely to help with attracting new investors because people start believing in the organization. So, it's likely to attract new investors, shareholders and more equity, higher credibility, higher trust in the organization. It enhances flexible borrowing conditions or facilities from financial institutions. Transparency is there, people can go back and check what was happening. So, the borrowing power increases. Decreasing credit interest rate and cost of capital. New investment opportunities come up. Attracting better personnel or better employees and reaching new markets. Now, good corporate governance is likely to be influenced, or corporate governance in general is likely to be influenced by the following. One is politics. Politics will influence the policies of the government, the pressures, the external pressures on the organization, what the company is dealing with, the external environment. Economics will influence the organization, management, both internal and external, accounting within the organization, ethics, the ethical standards and values that the organization follows or holds dear, and the values followed by the value system of the employees will affect the way the organization is governed or run, and the law, the legal requirements that the organization has to adhere to. So these, so all of these factors will influence how these systems are created and how these structures are put in place. And that is all we have time for in this lecture. We will continue with some more discussion on corporate governance in the next class. Thank you very much for listening.